The investor.
How the Rich Grow Their Money. Written and published by Audiobooks. A game the wealthy are playing, that most people don't even see. If you want to understand how the rich grow their money, you first need to understand a hard truth. Wealthy people are not playing the same financial game as everyone else. Most people spend their lives trying to save their way to financial security, cutting back on coffee, clipping coupons, and hoping a traditional job and a retirement fund will one day set them free. Meanwhile, the rich are quietly using an entirely different playbook. They're not working for money. They're making money work for them. They're not trading time for income. They're buying assets that generate income while they sleep. They're not reacting to the economy. They're shaping their own. The gap between the rich and everyone else isn't just about income. It's about information, mindset, and decisions. The wealthy don't have more hours in a day, but they use their hours differently. They don't have supernatural intelligence, but they think about money in ways that most people never do. And that difference in thinking, more than luck, background, or even education, is what separates those who struggle from those who build empires. Money isn't the goal, it's the tool. Here's the first major mindset shift. The rich don't chase money for its own sake. They see money as a tool, a powerful one, to build freedom, opportunities, and influence. While most people focus on how to earn more, the wealthy obsess over how to deploy money intelligently. They understand that a dollar sitting idle loses value to inflation, but a dollar invested in a business, a stock, a property, or even a skill, has the potential to grow exponentially. The goal isn't to pile up cash. The goal is to convert money into assets that produce more money. And here's the secret. Once money starts working for you, everything changes. The rich use this principle to build momentum. They reinvest profits, compound returns, and use cash flow to acquire even more assets. This is why wealth grows faster the further along you are. Because money, once set in motion, becomes a self-replicating machine. The 3 ladders of wealth. There's a predictable path that nearly every self-made millionaire follows. It's not random, it's strategic, and it always begins with understanding the 3 ladders of wealth. You exchange time for money, a paycheck, a salary, a commission. It's essential at the start, but it's the slowest and most limited way to grow wealth. Passive income, money working for you. The wealthy quickly transition to this state. They invest in assets, real estate, stocks, businesses, that generate income without their constant involvement. Scalable income, systems building wealth. This is the ultimate level. Here you're not just investing in assets, you're creating systems that scale without your presence. Think businesses, funds, or platforms that continue growing even while you sleep. The mistake most people make is spending their entire lives climbing the first ladder and never moving to the second or third. The rich see the first stage as temporary, a launch pad to build capital and move into investments that compound their wealth. Why the middle class stays stuck. Most people never become investors, not because they don't have the opportunity, but because they've been taught to think like consumers, not wealth builders. Schools train people to become employees. Society teaches them to spend what they earn. Banks encourage them to save instead of invest. The result? A lifetime of working hard but never getting ahead. A steady paycheck that covers expenses but never compounds. A false sense of security built on jobs and pensions that can disappear overnight. Meanwhile, investors, even those who start with far less, quietly build wealth behind the scenes. They understand that investing is not about luck or timing the market. It's about consistently turning earned income into ownership, compounding, and leverage. The wealth formula: earn, save, invest, repeat. At its core, building wealth is simple, but simplicity is often overlooked. Every wealthy person follows a version of this formula. Earn, build skills, provide value, and generate income. Save, live below your means and create capital. Invest, use that capital to acquire assets that produce more income. Even modest investments, if made consistently, grow into significant wealth. And once your investments generate enough income to cover your lifestyle, you're no longer trapped by the need to work for money. The investor's edge: patience and perspective. If there's one skill that separates the rich from the average, it's patience. Most people chase quick wins. They want overnight returns, instant results, and rapid wealth. But real investors think in decades, not days. They know that wealth is not built in sudden leaps, but through steady, disciplined action. They zoom out. They ignore the noise of daily market fluctuations. They focus on the fundamentals: value, cash flow, growth potential, and long-term trends. And because they stay in the game long enough, they reap the rewards that short-term thinkers miss. Your first step: start thinking like an investor. You don't need millions to become an investor. You need a shift in mindset. The moment you stop trading time for money and start thinking about how to make money work for you, everything changes. Start where you are. Learn about assets. Build financial literacy. Automate your save. Even if you invest a small amount, you're planting the seed of wealth. And over time, that seed can grow into financial freedom. Remember, wealth is not about how much you earn. It's about how much you keep, how wisely you invest it, and how consistently you allow it to come. This is the game the rich are playing, and now you're about to learn how to play it too. The difference between struggling financially and building lasting wealth isn't luck, it's strategy. And by mastering the mindset and methods of true investors, you'll put yourself on the path to financial independence, not someday but starting now. The hidden game of wealth. Why the rich keep getting richer. If you want to know how the rich grow their money, the first thing you must understand is this. They are not playing the same game as everyone else. Most people spend their lives running in circles, working hard, earning a paycheck, paying bills, maybe saving a little, and hoping one day it will all add up. But for the wealthy, the game is entirely different. They're not chasing money. They're building system. They're not working for income. They're acquiring assets that pay them whether they're awake or asleep. The gap between the rich and everyone else isn't just about how much they earn. It's about how they think. They follow a strategy that most people never even learn. It's not about luck. It's not about winning the lottery or inheriting wealth. It's about understanding how money works and using it strategically to build more of itself. The truth is simple, but uncomfortable. If you don't learn how to make money work for you, you will spend your entire life working for money. And that is exactly where most people stay, trapped in a cycle of earning and spending, without ever building lasting wealth. But the investor's mindset, the foundation of wealth. The first major difference between the rich and everyone else is mindset. The average person sees money as something to spend. The wealthy see money as something to deploy. Most people think, how can I earn more so I can buy more? Investors think, how can I make my money earn more money for me? It transforms how you make decisions, how you see risk, how you plan for the future, and how you build wealth over time. Money in the hands of an investor is not just currency, it's a worker, and every dollar has a job to multiply. Instead of spending every cent they earn, the wealthy allocate a portion of it to investments, assets that generate income, grow in value, and work 24/7 without their involvement. The result, while most people's income stops the moment they stop working, the investor's income keeps flowing, because their money is always working harder than they are. The money trap. Why most people never escape. If building wealth were as simple as saving and investing, everyone would be rich. But the truth is, most people never even make it to the investment stage, because they fall into what I call the money trap. The money trap looks like this, and when an emergency hits, you're back to zero. This cycle repeats for decades. People get promotions, they earn more money, but their lifestyle grows with it, and so do their expenses. It's called lifestyle inflation, and it's the reason even high earners stay broke. Investors don't play this game. They prioritize investing before spending. They pay themselves first, putting a percentage of their income into assets, before they upgrade their lifestyle. This discipline is what allows them to build wealth steadily, while everyone else treads water. Money is a tool, not a goal. Here's another key mindset shift. For the rich, money is not the goal, freedom is. Money is just the tool they use to build that freedom. The wealthy don't measure success by how much they earn or how expensive their possessions are. They measure success by how much control they have over their time. True wealth isn't about having millions in the bank. It's about having the freedom to wake up and decide exactly how you want to live each day. That freedom comes from assets that generate income, without constant effort, rental properties, dividend-paying stocks, businesses, royalties, and more. These assets buy you time, and time is the ultimate luxury. The 4 phases of wealth creation. Every wealthy person, whether they started with nothing or inherited a fortune, goes through 4 predictable phases on their journey to financial freedom. Understanding these phases will help you see exactly where you are and what to do next. Earning. You trade time for money. This is where most people start. Building skills, finding work and generating income. Saving. You learn to live below your means and set money aside. Saving isn't about getting rich. It's about building capital to invest. Investing. You use that capital to acquire assets that grow and produce income. This is where wealth begins to compound. Scaling. Your investments start producing more income than your job. You reinvest profits, create systems, and scale your wealth exponentially. The key is to move through these stages deliberately. Most people never get past stage 2 because they never learn how to invest or they're too focused on spending. But once you reach stage 3, your wealth begins to grow on autopilot. The investor's edge. Time and compounding. One of the most powerful secrets the wealthy understand is the magic of compounding. Compounding is what happens when your money starts earning returns and then those returns earn returns of their own. Over time, this creates exponential growth. Albert Einstein famously called compounding the eighth wonder of the world. Why? Because it turns small, consistent investments into massive wealth over time. The earlier you start, the more powerful compounding becomes. That's why wealthy people invest as soon as possible, even small amounts. They know that time is the greatest multiplier of wealth, and every year you delay, you lose one of your biggest advantages. From worker to investor. If you want to join the ranks of those who grow wealth, you must make the transition from worker to investor. That doesn't mean quitting your job tomorrow. It means shifting your focus from earning income to building assets. Start small if you must. Automate investments into index funds. Learn about real estate. Explore business opportunities. The point is to stop letting your money sit idle and start putting it to work. Over time, those small investments become streams of income. Those streams become rivers, and eventually, those rivers create an ocean of financial freedom, one that no job, no recession, and no economic downturn can take away from you. The wealth game has already begun. Here's the truth. The wealth game is happening whether you choose to play or not. Every day, people who understand how money works are building assets, creating cash flow, and compounding their wealth. And every day, those who don't are falling further behind, trapped in a cycle of work and spend. The good news is that it's never too late to start. Your journey begins with a single decision: to stop being a consumer and start becoming an investor. Once you make that shift, you'll see opportunities everywhere. Opportunities to grow, to build, and to create the financial future you deserve. This is the foundation of wealth, and it's only the beginning of the journey the rich already understand. The rest of this audiobook will teach you how to think, act, and invest like them, so that your money isn't just earned, but multiplied. And once you learn how to do that, financial freedom is no longer a dream, it's inevitable. The power of perspective. Think like an investor, not a consumer. If you want to understand how the rich grow their money, the first and most crucial shift isn't in your bank account, it's in your mindset. Wealth is not built by those who simply earn more or save harder. It's built by those who think differently about money itself. In this chapter, we'll break down one of the most powerful mental shifts the wealthy make early on, and why it's the dividing line between people who work for money and those who make money work for them. Consumers spend, investors multiply. Most people go through life as consumers. They earn money and immediately think about how to spend it on a better lifestyle, a new car, the latest tech, or even a vacation. That's how the system trains us to behave. Society wants you to consume because consumption fuels the economy. But here's the truth the wealthy know. Every dollar you spend today is a seed you choose not to plant. Investors, on the other hand, see money as a tool. They don't measure its worth by what it can buy. They measure it by what it can become. Every dollar has potential energy. When invested wisely, it can grow into more dollars, which can then grow into more opportunities. The rich don't see money as something to spend. They see it as capital, a worker they send out to earn more on their behalf. Here's the fundamental difference. Consumer mindset: I have $1,000. What can I buy with it? Investor mindset: I have $1,000. How can I turn it into $5,000? The first mindset gives you instant gratification. The second gives you compounding freedom. The formula wealthy people live by: capital consumption. The world's wealthiest individuals, from Warren Buffett to everyday self-made millionaires, all understand this simple rule. Use capital to buy assets, and let assets buy your lifestyle. If you reverse that order, buying lifestyle first and hoping to invest later, you stay stuck forever. The reason most people never achieve financial independence is because they build their spending around their income instead of around their investing strategy. For example, a consumer gets a $5,000 raise and immediately upgrades their car payment. An investor gets a $5,000 raise and uses it to buy dividend-paying stocks or invest in a business. 5 years later, the consumer still needs to work for every dollar. The investor's money is now generating more money, possibly covering their lifestyle costs entirely. Money has a job. Give it one. One of the most common mistakes people make is letting money sit idle, or worse, spending it without purpose. Rich people treat money like employee. Every dollar has a job, a purpose, and an expected return. If they have $1,000 lying around, it's not extra money. It's a worker waiting for an assignment, whether that's in real estate, stocks, a business, or self-education. Start thinking like a capital allocator. Whenever you get paid, don't ask, what do I want to buy? Ask, where will this money work hardest for me? Even something as simple as investing in a high-yield savings account or a low-cost index fund is better than letting money collect dust in a checking account or disappear on random expenses. Delay pleasure. Accelerate freedom. The wealthiest people on the planet are masters of delayed gratification. They sacrifice short-term pleasures for long-term freedom. They don't care about impressing people today. They care about building a life tomorrow where they never have to impress anyone again. This is why the rich drive older cars while building wealth, why they invest heavily before upgrading their lifestyle, and why they focus on ownership instead of appearances. They understand that every impulse purchase is a trade-off against their future freedom. The question they constantly ask themselves is, would I rather have this thing now or have my money buy me freedom later? That single question can completely transform how you approach every spending decision. Think like a builder, not a buyer. To truly grow your wealth, you must stop thinking like a buyer and start thinking like a builder. Every purchase is either a brick in the foundation of your financial fortress or a hole in the wall you're trying to build. When you invest in an asset, you're adding bricks. When you spend on liabilities, you're removing them. Over time, these decisions compound. The rich become richer, not because they're lucky, but because they consistently direct money toward building wealth, not away from action step. Rewire your thinking today. To make this shift real, try this exercise. For the next 30 days before you make any purchase, no matter how small, pause and ask yourself, will this purchase grow in value or lose value? Could I invest this money instead? If I invested it, how much could it be worth in 5 years? This simple habit rewires your financial instincts from consumer to investor. Over time, those decisions add up, and they'll be the difference between relying on a paycheck forever and creating a life where your money works harder than you ever could. The journey to wealth doesn't start with a paycheck. It starts with perspective. Once you stop seeing money as something to spend and start seeing it as something to multiply, the doors to financial freedom swing wide open. In the next chapter, we'll go deeper into where the rich put their money and why they never invest like the crowd. The Wealth Blueprint, where the rich put their money and why. By now you understand that the wealthy think about money differently. They treat every dollar as a seed, not a ticket to spend. But mindset alone won't make you rich. What you do with your money is just as critical, and this is where most people go wrong. They scatter their money across random things. Flashy stocks, trendy crypto, get-rich-quick schemes, and wonder why they're still stuck in the same place. The rich, however, follow a deliberate, predictable, and proven blueprint for where their money goes. This part will reveal that blueprint, how wealthy people allocate, prioritize, and grow their capital, and how you can start building your own system today. The rich follow the 3-bucket rule. The average person thinks in terms of spending and saving. The wealthy think in terms of allocation. They split their money into 3 clear buckets, each serving a specific purpose. Let's break it down. 1. The security bucket. Protect what you build. Before the wealthy chase growth, they make sure they never go backward. That's why their first priority is security. This includes insurance, health, income and asset protection, safe investments, high-grade bonds, treasury bills or stable savings vehicles. The purpose of this bucket isn't to grow fast, it's to buy peace of mind. Without this foundation, every financial gain is vulnerable to a single unexpected event. This is why you'll rarely see wealthy individuals all in on high-risk plays. They protect the downside before they chase the upside. The growth bucket. Multiply money aggressively. Once the foundation is secure, the wealthy move to the growth stage. This is where they focus on multiplying their capital through high-return opportunities. But unlike amateurs, they don't gamble. They invest strategically with a clear plan. Some common growth vehicles include the stock market, long-term investments in index funds, blue-chip stocks, or sector-specific ETFs. Businesses, either building their own companies or acquiring equity in others. Private investments, venture capital, angel investing, or private equity for those with higher risk tolerance. The key difference here is time horizon. Wealthy people think in decades, not days. They understand that compounding, the most powerful force in finance, takes time. That's why they avoid daily trading and short-term speculation. They'd rather own quality assets and let them grow quietly in the background. 3. The freedom bucket. Passive income and legacy. The third bucket is where wealth becomes self-sustained. This is money that no longer requires active effort. It works for you, not the other way around. Examples include DICA, dividend-paying stocks, real estate cash flow, royalties and intellectual property, automated online businesses, income from funds, REITs, or limited partnerships. This is the ultimate destination. Your assets cover your lifestyle and work becomes optional. At this point, you're not trading time for money. Your money is buying back your time. The rich don't diversify, they focus. One of the biggest myths in personal finance is diversify everything. While diversification is useful for protection, the wealthy know that wealth is built through concentration and only protected through diversification. They don't scatter money across 50 different investments and hope something works. Instead, they double down on what they deeply understand. Warren Buffett famously said, "Diversification is protection against ignorance." It makes little sense if you know what you're doing. This doesn't mean taking reckless bets. It means studying deeply, mastering 1 or 2 areas like real estate, stocks, or business, and focusing capital there. That focused intensity accelerates returns and wealth far faster than spreading money to reinvest, reinvest, reinvest. The difference between a wealthy investor and everyone else is not just what they invest in, It's what they do after they profit. Most people take their returns and spend them. The rich reinvest. This is the engine of exponential growth. When your money earns money, and that money also earns money, you create a compounding snowball that becomes unstoppable over time. It's how $10,000 can grow into $1 million. Not because of luck, but because of disciplined reinvestment. Think of wealth like a tree. The first seed you plant may take years to grow, but once it bears fruit, you can plant those seeds too. Eventually you're not tending one tree, you're managing a forest. Action plan. Build your own 3-bucket system. Here's a simple way to apply this wealth structure today. Growth, 50-60%. Direct most of your capital here: stocks, real estate, or business ventures. Freedom, 10-20%. Reinvest into passive income streams that will one day replace your active income. Review your allocations every 6-12 months and adjust as your wealth grows. Over time, you'll notice something powerful. Your money will start multiplying itself. Remember, the rich aren't lucky, and they're not playing a different game. They're just following a smarter blueprint. They protect their foundation, focus their investments, and reinvest their return. The wealth blueprint, where the rich put their money, and why. By now you understand that the wealthy think about money differently. They treat every dollar as a seed, not a ticket to spend. That mindset alone won't make you rich. What you do with your money is just as critical, and this is where most people go wrong. They scatter their money across random things, flashy stocks, trendy crypto, get-rich-quick schemes, and wonder why they're still stuck in the same place. The rich, however, follow a deliberate, predictable, and proven blueprint for where their money goes. This part will reveal that blueprint, how wealthy people allocate, prioritize, and grow their capital, and how you can start building your own system today. The rich follow the 3-bucket rule. The average person thinks in terms of spending and saving. The wealthy think in terms of allocation. They split their money into 3 clear buckets, each serving a specific purpose. Equity bucket, protect capital. Growth bucket, multiply capital. Freedom bucket, create passive income. This system ensures that every dollar is working optimally, and none is wasted. Let's break it down. 1. The security bucket, protect what you build. Before the wealthy chase growth, they make sure they never go backward. That's why their first priority is security. This includes emergency funds, 6-12 months of living expenses in liquid accounts, insurance, health, income and asset protection, safe investments, high-grade bonds, treasury bills, or stable savings vehicles. The purpose of this bucket isn't to grow fast, it's to buy peace of mind. Without this foundation, every financial gain is vulnerable to a single unexpected event. This is why you'll rarely see wealthy individuals all in on high-risk plays. They protect the downside before they chase the upside. The growth bucket, multiply money aggressively. Once the foundation is secure, the wealthy move to the growth stage. This is where they focus on multiplying their capital through high-return opportunities. But unlike amateurs, they don't gamble. They invest strategically with a clear plan. Some common growth vehicles include the stock market, long-term investments in index funds, blue-chip stocks, or sector-specific ETFs. Businesses, either building their own companies or acquiring equity in others. Real estate, properties that appreciate and generate steady rental income. Private investments, venture capital, angel investing, or private equity, for those with higher risk tolerance. The key difference here is time horizon. Wealthy people think in decades, not days. They understand that compounding, the most powerful force in finance, takes time. That's why they avoid daily trading and short-term speculation. They'd rather own quality assets and let them grow quietly in the background. 3. The freedom bucket, passive income, and legacy. The third bucket is where wealth becomes self-sustaining. This is money that no longer requires active effort. It works for you, not the other way around. Examples include dividend-paying stocks, real estate cash flow, RALI, and intellectual property automated online businesses, income from funds, REITs or limited partnerships. This is the ultimate destination. Your assets cover your lifestyle, and work becomes optional. At this point, you're not trading time for money. Your money is buying back your time. The rich don't diversify, they focus. One of the biggest myths in personal finance is diversify everything. While diversification is useful for protection, the wealthy know that wealth is built through concentration and only protected through diversification. They don't scatter money across 50 different investments and hope something works. Instead, they double down on what they deeply understand. Warren Buffett famously said, "Diversification is protection against ignorance." It makes little sense if you know what you're doing. This doesn't mean taking reckless bets. It means studying deeply, mastering 1 or 2 areas, like real estate, stocks, or business, and focusing capital there. That focused intensity accelerates returns and wealth far faster than spreading money too thin. Reinvest, reinvest, reinvest. The difference between a wealthy investor and everyone else is not just what they invest in, it's what they do after they profit. Most people take their returns and spend them. The rich reinvest. This is the engine of exponential growth. When your money earns money, and that money also earns money, you create a compounding snowball that becomes unstoppable over time. It's how $10,000 can grow into $1 million, not because of luck but because of disciplined reinvestment. Think of wealth like a tree. The first seed you plant may take years to grow, but once it bears fruit, you can plant those seeds too. Eventually you're not tending one tree, you're managing a forest. Action plan: build your own 3-bucket system. Here's a simple way to apply this wealth structure today. Growth, 50-60%. Direct most of your capital here: stocks, real estate, or business ventures. Freedom, 10-40%. Over time you'll notice something powerful. Your money will start multiplying itself. The Wealth Acceleration Code. How the rich use other people's money. There's a reason the rich get richer, and it's not just because they invest wisely. It's because they understand a fundamental truth about wealth. Your money alone will never make you rich fast enough. The wealthy don't rely solely on their own capital to grow. Instead, they master one of the most powerful wealth-building tools on earth: leverage. And the most effective form of leverage? Other people's money. OPM. This is the quiet strategy behind real estate empires, business expansions, and investment portfolios that grow 10x faster than the average investor could ever achieve on their own. Once you understand and master OPM, ethically, strategically, and intelligently, you unlock a level of wealth acceleration that working harder or saving more can never give you. The rich don't fear debt, they master it. Most people are taught that debt is dangerous. They're told to avoid loans, pay off everything, and never owe anyone a cent. While that advice makes sense for consumer debt, like credit cards or lifestyle spending, it's a mindset that keeps people trapped in financial mediocrity. Wealthy people think differently. They separate bad debt from good debt. Bad debt is used to buy things that lose value: cars, vacations, gadgets. Good debt is used to acquire assets that produce income or appreciate in value. The rich don't avoid debt. They use it as a tool. They borrow money at low interest rates to buy assets that deliver higher returns. It's not about owing money. It's about controlling assets far larger than your own cash flow would allow. How OPM works. The 3 levels of leverage. Let's break down how the wealthy use other people's money to grow faster than they ever could on their own. Bank leverage. Using credit to acquire assets. The most common form of OPM is borrowed money from banks or financial institutions. This is how most real estate empires start. For example, you have $50,000. Instead of buying one small property in cash, you use that $50,000 as a 20% down payment on a tool. The bank funds the other two. Now, instead of owning a $50,000 asset, you control a $250,000 one, which means, you earn rental income on the full property value. You benefit from appreciation on $250,000, not just $50,000. Your $50,000 is still yours, but it's now controlling 5 times that value. 2. Investor leverage. Partnering to grow faster. The wealthy also know how to use other people's capital through partnerships and joint ventures. Instead of waiting years to build up cash, they collaborate with investors who bring money, while they bring knowledge, strategy, or sweat equity. Example: you find a profitable real estate deal but don't have enough cash. An investor funds the project. You manage the property. You split the profits. Both of you win, and you now have a larger portfolio without needing all the capital yourself. This principle extends far beyond real estate. Many businesses, startups, and private ventures are built using OPM from investors, venture capital, or angel funding. The wealthiest individuals are not always the ones with the most cash. They're the ones who know how to attract and deploy other people's capital effectively. 3. Business leverage. Customers fund your growth. One of the most powerful and overlooked forms of OPM is revenue itself. Many successful companies grow using customer pre-orders, subscription models, or cash flow from sales, essentially using their customers' money to fuel their expansion. Think of this as internal OP. Instead of borrowing from banks or investors, you build a system that generates upfront cash, which is then reinvested to scale further. Amazon, Tesla, and countless startups use this principle to grow massively without always relying on outside finance. The power of compound leverage. The real magic happens when you combine these forms of leverage. A real estate investor might use a bank loan, leverage in 1, raise additional capital from partners, leverage in 2, and then use the rental income leverage in 3 to reinvest in new deal. A business owner might attract investors, use that capital to acquire customers, and then reinvest profits into product development and marketing. Each layer of leverage multiplies the others. This compounding effect is why the wealthy often experience exponential growth, while the average person sees only linear progress. The golden rule: risk control comes first. Of course, leverage is a double-edged sword. It can accelerate wealth, but it can also magnify losses if used recklessly. That's why the rich follow strict principles when using OPM. Never over-leverage. Leave room for market fluctuations. They treat borrowed money with extreme discipline, not emotion. It's a powerful tool, but like fire, it must be controlled to build wealth rather than destroy it. Action plan. Your first steps into OPM. You don't need millions to start using OPM. Even small, smart moves can accelerate your growth. They secure your credit. Build a strong credit profile to qualify for low-interest finance. Leverage small. Use modest loans to acquire your first cash-flowing asset. Partner up. Find someone who has capital but lacks time or expertise. Reinvest profits. Use the returns from leverage investments to fund bigger deals. Remember, the goal isn't just to borrow, it's to scale. Leverage is the bridge between where you are and where you want to be. The wealthy understand something most people never learn. Money is not the goal. It's a tool. And when you learn how to use other people's money intelligently, that tool becomes a force multiplier. Part 6. Mastering the Art of Risk. How the wealthy play the game differently. There's a reason the wealthy seem fearless when others are paralyzed by uncertainty. They don't avoid risk. They master it. In the world of investing, risk isn't the enemy. It's the very engine that drives growth. But here's the hidden truth. The difference between someone who loses everything and someone who builds generational wealth isn't luck, it's how they understand, manage, and leverage risk to their advantage. This chapter pulls back the curtain on how the rich think about risk, why their decisions look bold but are actually calculated, and how you can adopt the same mindset, even if you're starting small. But saying the risk-reward equation, most people misunderstand risk. They see it as something to avoid, a threat to their savings or lifestyle. The wealthy see it differently. To them, risk is a spectrum. It's not about whether risk exists, but how much and what kind of risk they're taking. They know that every investment carries risk. Even holding cash has the risk of losing value to inflation. The rich use a principle called asymmetric risk-taking, seeking opportunities where the potential upside significantly outweighs the possible downside. They don't gamble on unknown. Instead, they place calculated bets where the reward far exceeds the risk. They also understand that risk and time are interconnected. A risky investment over a long horizon becomes less volatile because time smooths out short-term fluctuation. That's why billionaires hold assets for decades while the average person sells at the first dip. Diversification is not what you think. You've probably heard the advice, don't put all your eggs in one basket. And while diversification is important, the wealthy don't diversify the way most people do. Average investors spread their money thin across dozens of random assets, hoping that balance will protect them. But over-diversification can dilute your returns and make it nearly impossible to outperform the market. The rich practice strategic diversification, a focused spread across uncorrelated high-conviction assets. They might hold real estate, equities, private businesses, and alternative investments like venture capital or art. But each investment has a purpose, and each plays a specific role in the portfolio. Think of it like building a championship team. You don't fill your roster with average players just to cover every position. You choose specialists who complement each other and increase your odds of winning. Risk management systems, the secret weapon of wealth. Risk mastery isn't about reacting when things go wrong. It's about building systems to prevent catastrophic losses before they happen. Wealthy investors are obsessed with downside protection. They think in terms of survival first, profit second. Here's how they do it. They stop-loss strategies, predetermined exit points to protect capital before a loss spirals out of control. Position sizing, never betting more than a small percentage of their portfolio on any single opportunity. Liquidity buffers, keeping cash reserves to act quickly during downturns and capitalize on new opportunities. It's not about eliminating risk. It's about never letting one mistake destroy the foundation of your wealth. Emotional mastery, the ultimate risk edge. Even the best risk analysis fails if you can't control your emotion. Fear and greed are the two forces that wreck most investors. They panic sell when markets drop and chase hype when prices rise. The wealthy operate with emotional detachment. They know that volatility is not a signal to act, but a test of discipline. This emotional mastery gives them the patience to hold through downwards, the courage to buy when others are scared, and the humility to take profits when things are euphoric. One of the most powerful mental models the rich use is this: volatility is the price of admission for superior return. If you can't stomach fluctuations, you'll never capture exponential growth. Playing offense and defense simultaneously. Risk management isn't just about protecting what you have. It's also about creating opportunities to grow. The wealthiest investors build dual-layer strategy. This approach ensures that even if their boldest bets fail, their wealth remains intact and continues compounding. And when those bets succeed, they accelerate wealth creation exponentially. Reframing risk as a skill. Here's the most important mindset shift. Risk isn't something to fear, it's a skill you can master. Just like learning to drive a car, you start cautiously, build experience, and eventually navigate more complex situations with confidence. The wealthy didn't become fearless overnight. They built their tolerance and understanding over time. Start small, take calculated risks, analyze outcomes, adjust. Over time, your confidence grows, and so does your wealth. Your risk mastery action plan. Assess your risk tolerance. Understand how much volatility you can handle without panicking. Audit your portfolio. Identify where you're overexposed and where you're underutilizing capital. Set guardrails. Decide on stop-loss levels, position sizes, and liquidity targets. Seek asymmetry. Look for opportunities with limited downside and significant upside. Practice emotional discipline. Create written rules for when you will buy, sell, or hold, and stick to them. The wealthy don't win by avoiding risk. They win by mastering it. They see what others fear as an invitation to grow, and they build systems, mindsets, and strategies to control what they can and thrive in uncertainty. If you want to grow your money like the rich, you must stop running from risk and start training with. Part 7. The power of leverage. How the wealthy multiply their money without working harder. If you study the lives of self-made millionaires and billionaires, you'll notice one pattern that repeats over and over again. They don't just rely on their own money, time, or effort. They multiply their results by using leverage, a principle that allows them to achieve far more with far less. Leverage is the great equalizer. It's how someone with average income builds a real estate empire, how small business owners outgrow competitors, and how investors with modest capital create fortunes. The wealthy understand that their personal effort is limited, but leverage is limited, and this single principle is one of the most powerful wealth accelerators in existence. In this part, we'll explore the different types of leverage, from money to people to systems, and how the rich use them strategically to grow wealth exponentially without burning themselves out. Understanding leverage. The multiplier mindset. At its core, leverage means using resources beyond your own to achieve more significant outcomes. Most people think wealth is built by working harder. The rich know it's built by compounding smarter. Here's the truth. If you rely only on your own money, your growth is limited by how much you can save. If you rely only on your own time, you're limited to 24 hours a day. If you rely only on your own effort, you'll always be trading hours for dollars. Leverage breaks these limits. It allows you to grow wealth faster than you ever could on your own, and often with less risk and effort. The wealthy build their entire financial lives around this principle. Leverage. 1. Other people's money. OP. Most people fear debt because they've only seen it used irresponsibly. The rich, however, use good debt money borrowed to acquire assets that generate more income than the cost of the debt itself. Here's how they do it. They use mortgages, allowing them to control a large asset with a small amount of their own money. If a property appreciates 10% on a $500,000 home, that's a $50,000 gain, even if they only invested a business expansion. Entrepreneurs use OPM to scale faster, financing growth, acquiring competitors, or investing in marketing that multiplies revenue. Investment portfolios, margin loans, business lines of credit, and strategic borrowing can accelerate returns if used wisely and with proper risk management. The wealthy don't fear debt. They fear missing opportunities by refusing to use it. Strategic leverage. 1. Earth equals time. OPP. Money isn't the only resource that can be leveraged. Time, especially other people's time, is one of the most powerful forms of leverage. Most people try to do everything themselves, which limits their growth. The wealthy delegate and outsource. In business, they hire talent, build teams, and delegate tasks that don't require their personal attention. This frees them to focus on high-level strategy and decisions that grow well. In investing, they leverage the expertise of financial advisors, property managers, and analysts, instead of trying to master every detail themselves. In life, they outsource routine tasks, from bookkeeping to home maintenance, so their time is spent where it generates the greatest return. Time is the only truly finite resource. Using other people's time allows the rich to scale their impact far beyond their personal limit. Leverage. 3. Other people's knowledge. OPK. The fastest way to accelerate wealth is to learn from those who've already achieved what you want. The wealthy are relentless about leveraging other people's knowledge. They invest in mentors, advisors, coaches, and partners. They don't waste years learning through trial and error when they can pay for expertise and leapfrog ahead. They also collaborate strategically, forming joint ventures, investing in startups led by experts, or partnering with people who have skills they lack. This mindset shift from "I'll do it all myself" to "I'll align with those who already know" can multiply results exponentially. Automated investing platforms, AI tools, business software and scalable online infrastructure allow wealth to grow without constant human input. Scalability: online businesses, digital products, and software tools scale revenue to thousands or millions of customers without needing more hours. Once systems are in place, they work 24/7, generating income and growth even while the investor sleeps. The wealth formula: leverage, time, the exponential growth. When you combine leverage with time, you unlock exponential wealth growth. Consider two investors. Investor A invests $10,000 of their own money, earning 8% annual. Investor B's $50,000 grows to about $233,000, minus $40,000 repayment, leaving $193,000 profit. Both took the same risk in the market, but one used leverage and walked away with over 4. Here's how the rich protect themselves. Always have a repayment plan. Never borrow without knowing how you'll repay it, ideally with the cash flow the asset itself generates. Don't over-leverage. Keep debt to income and debt to asset ratios within safe range. Use leverage for assets, not liabilities. Borrowing for investments is powerful. Borrowing for consumption is a trap. The wealthy treat leverage like fire. Dangerous if uncontrolled, but transformative used wisely. Your action plan to start using leverage: start small and controlled. Test with manageable amounts before scaling. Surround yourself with experts, advisors, mentors, or partners who have leveraged successfully. The wealthy don't grow rich by simply saving more or working harder. They multiply the impact of everything they do. Leverage is the tool that transforms modest opportunities into massive wealth, turning time into results, debt into profit, and knowledge into empire. Part 8. The compound effect. How the rich build massive wealth over time. If leverage is the tool that accelerates wealth, compounding is the invisible engine that powers it. This single principle is responsible for more fortunes than any business idea, investment strategy, or financial tactic in history. Albert Einstein called compound interest the eighth wonder of the world, and for good reason. Once you understand and harness it, time becomes your greatest ally, and wealth creation becomes almost inevitable. Most people underestimate compounding because its results are slow at first, but the wealthy play a different game. They think in decades, not days. They understand that compounding is not about getting rich quick. It's about building wealth that becomes unstoppable with time. Understanding compounding, the snowball that never stops. Compounding is the process of earning returns not just on your original investment, but also on the returns those investments have already generated. It's growth on top of growth, wealth building on autopilot. Imagine pushing a small snowball down a hill. At first it's tiny and slow, but as it rolls it gathers more snow, grows larger, and moves faster. Eventually it becomes an unstoppable force. That's exactly how compounding works with money. The problem is that most people never push the snowball long enough. They interrupt the compounding process by pulling money out too early, chasing quick returns, or constantly switching strategy. The rich do the opposite. They start the snowball as early as possible and let it roll uninterrupted for years. The time factor. Why the wealthy think in decades. The secret ingredient in compounding isn't the amount you invest or even the rate of return, it's time. The longer your money stays invested, the more powerful compounding becomes. Let's illustrate with an example. Investor A invests $500 a month from age 25 to 35, and then stops. Investor B invests $500 a month from age 35 to 65, 3 times longer, assuming an 8% annual return. This is why the wealthy prioritize starting early and staying consistent. Even small amounts can grow into massive wealth with enough time. The rule of 72. Seeing compounding in action. One of the simplest ways to understand compounding is the rule of 72. It's a quick formula that estimates how long it takes your money to double based on your rate of return. 72. At 12% returns it doubles every 6 years. At 6% returns it doubles every 12 years. This is why wealthy investors focus not only on earning steady returns but also on optimizing them. A few percentage points can make a life-changing difference when compounded over decades. Reinvesting. The golden rule of compounding. The key to maximizing compounding is simple. Reinvest everything. Every dividend, interest payment, or profit should be put back to work. This creates a powerful snowball effect where your wealth keeps generating more wealth, and that new wealth also starts generating wealth. This is where most people go wrong. They cash out too early, spend their gains, or let money sit idle. The rich reinvest relentlessly. They understand that money is like a seed. If you plant it and let it grow, it will multiply. If you eat the seed too early, the harvest ends. Patience. The secret weapon of the wealthy. Compounding rewards one trait above all: patience. Most people want quick results. The rich are willing to wait. They understand that compounding doesn't work on human timelines. It works on nature's. Wealth builds slowly. Then suddenly, The first 5-10 years of investing might feel slow, but the next 10-20 years often explode with growth. This is why wealthy investors don't panic during market dips. They see time as their ally and volatility as a temporary distraction. Knowledge. The more you learn, the faster you learn. Each skill builds on the last. Relationships. Each connection expands your network, which leads to more opportunities. Reputation. Trust grows slowly but compounds into influence and access. They treat every investment, financial or personal, as a compounding asset. This mindset ensures that every part of their life is growing exponentially, not linearly. How to harness compounding for your own wealth. To make compounding work for you, follow the same principles the wealthy live by. Start now, not later. Even if you can only invest small amounts, time is more valuable than money. Be consistent. Regular contributions beat occasional big ones. Reinvest everything. Let every dollar earn more dollars. Stay invested. Don't interrupt the process by chasing trends or reacting emotionally. Think in decades. Measure progress in 10 and 20-year timelines, not weeks or months. The compound effect in real life. Consider Warren Buffett, one of the most successful investors in history. Over 90% of his wealth was earned after age 65. That's not because he suddenly became a better investor. It's because compounding had decades to work. His snowball grew so large that even small percentage gains translated into billions. This is the mindset you need to adopt. Wealth is not built in sudden leaps but in consistent steps. Every dollar you invest today is not just money. It's potential energy that, given enough time, can turn into financial freedom. Your money can work harder than you ever could. The ultimate goal of compounding is to shift the burden of wealth creation away from you and onto your money. Instead of working harder for money, you make money work harder for you. And once compounding takes over, it doesn't just create wealth. It creates momentum. It becomes a self-sustaining machine that continues to grow with or without your active involvement. The wealthy don't rely on luck, timing, or genius. They rely on time, compounding, the two forces that never stop working, never sleep, and never run out of energy.
Part 9. Diversification. How the rich protect and grow their wealth in any economy. If compounding is how the rich build wealth, diversification is how they protect it. Wealth without protection is like building a skyscraper on sand. One storm can wipe it all away. That's why the wealthy don't just focus on making money, they focus just as intensely on keeping it. They know that true financial freedom isn't just about how fast you can grow, it's about how resilient your wealth is when the world changes. Diversification is the art and science of spreading risk intelligently. It's not about playing it safe or being overly cautious. It's about creating a portfolio that thrives in both boom times and recessions, one that can take a punch and still keep growing. And in a world full of uncertainty, inflation, market crashes, new technologies, political shifts, diversification isn't optional, it's survival. The wealth preservation mindset. Why the rich think defense first. The average person invests with one goal, maximum return. The wealthy invest with two, maximum returns, and minimum risk. They know the first rule of wealth. Don't lose money, because once you lose 50% of your wealth, you need a 100% return just to get back to where you started. Wealthy investors think like chess players. They don't make moves based only on what's happening today. They plan for 10 moves ahead. They ask, and what happens if the market crashes? The 3 levels of diversification. Diversification isn't just about owning multiple stocks. The rich diversify on 3 levels, and this layered approach is what gives their wealth resilience. Asset class diversification. Spreading across investment types. The first level of diversification is owning different types of investments, each with its own strengths, risks, and cycles. This reduces the chance that one bad event will ruin everything. The wealthy often diversify across stocks, equities, growth potential and liquidity, bonds, fixed income, stability and predictable income, real estate, tangible assets that generate cash flow and hedge against inflation, commodities, gold, silver and other commodities that hold value during economic uncertainty, private equity, venture capital, high-risk, high-reward opportunities outside public markets, cash and cash equivalents, safety and liquidity for emergencies or opportunity. Each asset reacts differently to economic changes. For example, stocks might fall during a recession, but bonds or gold may rise. Real estate might stagnate, but dividend-paying companies can still provide income. The balance is what keeps the wealthy stable. Geographical diversification, protecting against local risks. The next level is geographical diversification, investing across countries and regions. Most people's investments are heavily tied to their home economy. If that economy suffers, their entire portfolio does too. The rich don't make that mistake. They invest globally, in emerging markets with high growth potential, stable developed economies, and regions with different economic drivers. This ensures that no single country's policies, politics, or economic shocks can destroy their wealth. Industry and sector diversification, riding multiple waves, even within asset classes like stocks. Diversification matters. The wealthy spread their investments across multiple sectors: technology, healthcare, finance, energy, consumer goods, and more. Why? Because industries move in cycles. Tech might boom one year, but healthcare might lead the next. If you're concentrated in one sector and it crashes, you're exposed. But if your wealth is spread across multiple industries, your portfolio stays balanced and keeps compounding. Beyond investments, diversifying income streams. True diversification isn't limited to investments. It extends to income as well. The wealthy rarely rely on a single source of income. Instead, they create multiple streams that support and strengthen each other. In active income, businesses, salaries or consulting work; passive income, dividends, rental properties, royalties or interest; portfolio income, capital gains from stocks, bonds or other investments. This is crucial because even if one stream dries up, say a business faces a downturn, the others continue to flow. Diversified income isn't just about money, it's about peace of mind. Risk management, preparing for the unknown. Diversification works best when combined with smart risk management. Wealthy investors don't just spread risk, they plan for it. Here's how they do it. Emergency funds, cash reserves for unexpected events, so they never have to sell investments at the wrong time. Insurance, life, disability, property and liability insurance to protect against catastrophic loss. Hedging strategies, using options, commodities, or inverse funds to protect against market declines. Rebalancing, periodically adjusting their portfolio to maintain their desired risk level and avoid overexposure. They don't assume the future will be smooth. They build wealth expecting storms and designing their financial systems to withstand them. The psychology of diversification, patience over perfection. One reason many investors fail at diversification is psychological. They want every investment to win. But the truth is, in a well-diversified portfolio, something will always underperform. That's not a sign of failure. It's a sign that you're protected. Wealthy investors accept that not every asset will skyrocket. Instead, they focus on the overall performance of the portfolio. They care about the forest, not individual trees. And over decades, this patient, disciplined approach beats the roller coaster of trying to pick winners. Building your diversified wealth plan. Here's how you can start applying diversification like the wealthy. And spread your investments across multiple asset classes. Don't rely solely on stocks or real estate. Expand globally. Look beyond your home market for growth and safety. Invest across industries. Don't chase one trend. Own multiple opportunities. Create multiple income streams. Turn your skills, capital and ideas into layered income. Rebalance regularly. Review and adjust your portfolio annually to maintain balance. Why diversification is the ultimate insurance policy. At its heart, diversification is about control. It's about refusing to let a single market crash, economic shift, or government policy decide your financial future. It's how the wealthy sleep well at night, knowing that no matter what happens in the world, their wealth is protected, growing and compounding. It's not about avoiding risk altogether. Risk is part of wealth creation. It's about controlling, and when you control risk, you control the outcome. The rich don't just build wealth, they fortify it. They create portfolios that are strong, flexible, and built to last generations. And once you understand and implement diversification, your wealth stops being fragile and starts becoming anti-fragile, growing stronger with every challenge.
Mastering the game? Think like an investor, not a spender. There's a secret that separates the wealthy from everyone else, and it's not luck, inheritance, or insider knowledge. It's the way they think. By part 10 of this journey, you should no longer view investing as something only rich people do. You should see it as the most powerful tool you have for freedom, independence, and impact. This final part brings it all together, showing you how to adopt the mindset, strategies, and long-term perspective of the world's most successful investors. The wealth mindset, patience, discipline, and vision. Investing is 80% psychology and 20%. Most people fail not because they choose the wrong stock or fund, but because they panic, chase trends, and give up too soon. Wealthy investors are different. They think decades ahead, not days. They embrace market cycles instead of fearing them. And they understand that wealth is not built by timing the market, it's built by time in the market. Adopt these principles. Long-term patience. They don't get distracted by daily market noise. They focus on compounding, not quick wins. Confidence in research. They invest in what they understand, and they trust their analysis instead of chasing hype. When you shift from a short-term consumer mindset to a long-term investor mindset, you stop asking, how can I make money fast, and start asking, How can I build wealth that lasts? Automating your wealth building machine. One of the most underrated secrets of the wealthy is automation. They set up systems so their money works without their constant input. Once your investing foundation is built, you should aim to make it automatic. Automatic contributions. Schedule recurring investments into your brokerage or retirement accounts every month. Dividend reinvestment. Let your dividends buy more shares instead of cashing them out, compounding your returns effortlessly. Auto rebalancing. Use tools that automatically adjust your portfolio to maintain your ideal asset allocation. This approach removes emotions, prevents procrastination, and ensures you consistently build wealth, even when life gets busy. Diversification and adaptation. Staying strong through change. The rich never bet everything on one idea. They understand that markets evolve, industries rise and fall, and innovation reshapes the future. That's why they build diverse portfolios, mixing stocks, bonds, real estate, businesses, and sometimes alternative assets like commodities or private equity. But they also adapt. They pay attention to macroeconomic trends, technological shifts, and global dynamics, not to panic, but to position themselves early. For example, they might reduce exposure to declining industries. They invest more heavily in emerging technologies or demographics. They explore new markets as economies grow around the world. This balance, stability through diversification and growth through adaptation, keeps their wealth not just intact but expanding. The legacy investor. Building beyond yourself. True wealth isn't just about living comfortably, it's about creating something that outlives you. The world's most successful investors don't just grow money for themselves, they use it to shape the future. Here's how you can do the same. Teach investing to your family. Pass on financial wisdom so future generations continue building on your foundation. Create income-generating assets, businesses, real estate, and investments that provide cash flow even when you're gone. Give with impact. Philanthropy and strategic giving allow your wealth to improve lives and create a legacy of purpose. This mindset, thinking generationally, changes everything. You're no longer just investing for a lifestyle. You're investing for a legacy. Your investor identity. A final challenge. By now you've learned the mindset, principles, and strategies that the rich use to grow their money. But knowledge means nothing without action. So here's your challenge. Create a clear investing plan, including your goals, risk tolerance, timeline, and monthly contributions. Automate your system. Make wealth building happen without relying on motivation. Wealth is not built overnight. It's built in the quiet consistency of years. While others spend, you invest. While others react, you stay the course. And while others dream, you build. The only difference between you and them is execution. If you commit to thinking and acting like an investor, patiently, strategically, and relentlessly, wealth will not be a question of if, but when. This isn't the end of your journey. It's the beginning of a lifelong partnership with money, one where it works for you, multiplies for you, and ultimately frees you. You are no longer just earning money. You are building wealth. You are the investor.